In 2012, the Philippines, a country often seen as a recipient of aid, found itself at the center of an unexpected financial headline. For decades, the Philippines had been portrayed as a developing nation, frequently on the receiving end of international assistance and loans. But that year, something remarkable happened that would challenge global perceptions. The Philippine government pledged to lend a substantial sum to help stabilize Europe's economy, which was reeling from a severe debt crisis. Europe, home to some of the world's wealthiest nations, was facing economic turmoil, and the world watched anxiously as the crisis threatened to spread. The news was met with disbelief and pride, both at home and abroad. Many Filipinos were astonished to see their country in a position to offer help rather than seek it. International observers, too, were surprised by this reversal of roles. It challenged the old narrative, a developing nation supporting one of the world's richest regions. This act was more than just a financial transaction. It was a statement that the global balance of power was shifting and that emerging economies could play a vital role in international affairs. The story wasn't about charity, but about the Philippines stepping up as a responsible global player. By participating in this effort, the country demonstrated its growing confidence and its willingness to contribute to global solutions. This wasn't a direct loan to Europe, but a commitment through the International Monetary Fund, or IMF. The IMF acts as a financial safety net for countries in crisis, pooling resources from its member nations to provide support where it's needed most. The Philippines joined a collective effort, contributing to a global safety net designed to prevent economic contagion. By adding its resources to the IMF, the Philippines helped ensure that financial shocks in one region wouldn't spiral out of control and threaten the entire world economy. This move signaled a shift. Emerging economies like the Philippines were no longer just bystanders. They were now stakeholders in global stability, with a seat at the table and a voice in shaping the future of international finance. The decision was strategic, not just symbolic. In a globalized world, a crisis in Europe could ripple back to the Philippines, affecting trade, investments, and even jobs at home. By helping to stabilize Europe, the Philippines was also protecting its own economic interests. The story of this loan is really the story of globalization in action. It's a reminder that in today's interconnected world, the fortunes of nations are linked more closely than ever before. The Philippines' bold move in 2012 showed that even countries once seen as peripheral can play a crucial role in shaping the global financial landscape. In 2012, the world was still reeling from the aftershocks of the 2008 financial crisis. The global economy, though showing signs of recovery, remained fragile and uncertain. Stock markets were volatile, and the scars of the recession were still visible in many countries. Unemployment rates were high, and confidence in the financial system had not yet fully returned. Governments and central banks around the world were working tirelessly to restore stability, but the path forward was anything but clear. Just as some nations began to regain their footing, the European debt crisis erupted, sending shockwaves through the global financial system. The crisis exposed deep vulnerabilities within the Eurozone, and fears of contagion spread rapidly. Countries like Greece and Spain found themselves at the epicenter of the turmoil. Their economies teetered on the brink of collapse, with soaring unemployment, public protests, and mounting debt threatening not only their own futures, but also the stability of the entire global economy. The world watched anxiously as European leaders scrambled to find solutions. In response, the International Monetary Fund, under the leadership of Christine Lagarde, issued a bold call to action. The IMF urged its member nations to contribute $430 billion in new resources, aiming to build a robust financial firewall that could contain the crisis and prevent it from spreading further. This was a moment of unprecedented urgency and cooperation. Importantly, this call wasn't directed solely at the world's wealthiest nations. For the first time, emerging economies were asked to play a significant role in safeguarding global financial stability. Their growing influence and resources were now essential to the collective effort. The Philippines, under President Benigno Aquino III, stood out as a beacon of resilience in the region. The country's economy was robust, with record-high foreign reserves, steady growth, and a reputation for prudent fiscal management. The government had worked hard to strengthen its financial position, and the results were clear for all to see. Years of careful economic stewardship, combined with the unwavering support of millions of overseas Filipino workers who sent remittances home, had built up the nation's financial strength. These remittances not only supported families but also contributed to the country's impressive reserves, providing a crucial buffer against external shocks. The IMF's call for support was more than just a financial request. It was a test of global solidarity and cooperation. The Philippines, recognizing the stakes, chose to answer that call. By stepping up, the country demonstrated its commitment to the international community and its willingness to share responsibility in times of crisis. The decision to contribute was not made lightly. It was a calculated strategic response to a global emergency, reflecting a deep understanding that in an interconnected world, no nation is truly isolated from the challenges faced by others. The move was about safeguarding the Philippines' own economic interests as much as it was about helping others. In today's deeply interconnected global economy, the fate of one nation can quickly impact many others. By supporting the IMF's efforts, the Philippines was not only protecting itself from potential fallout, but also contributing to the stability and prosperity of the wider world. This bold move marked the Philippines' arrival as a credible and responsible player in international finance. It was a statement of confidence, both in the country's own future and in the power of global cooperation to overcome even the most daunting challenges. Let's clear up a common misconception that often circulates in the news and on social media. Many people believe that the Philippines simply handed over a massive sum of $250 million directly to the European Union, as if it were a straightforward loan or a bailout. But that's not what actually happened, and understanding the real story is important for seeing how global finance works. In reality, the Philippines didn't just send $250 million to the EU or any single country. There was no direct transfer of cash from Manila to Brussels, and no single nation received a check from the Philippine government. Instead, the funds were pledged to the International Monetary Fund, or IMF, which is a global financial institution made up of nearly every country in the world. The money wasn't earmarked for Europe or any specific region. It was a commitment to the IMF's general resources, which are used to help any member country facing financial trouble. Think of the IMF as a kind of global credit cooperative. All member countries contribute to a central pool of funds. When a country faces a crisis, whether it's in Asia, Africa, Europe, or the Americas, it can request support from this pool. The idea is to create a safety net that protects the entire global economy, not just one region. The Philippine government's action was to increase its credit line to the IMF. This means the country agreed to make more of its reserves available if the IMF needed them, but it didn't actually send the money out of the country right away. In fact, the pledged funds stayed safely within the Philippines' own reserves unless the IMF called on them. While sitting in reserve, these funds continued to earn interest, helping the country's finances rather than draining them. Lending to the IMF is considered much safer than lending to a single country, because the IMF has what's called preferred creditor status. This means it gets paid back first, even if a borrowing country runs into trouble. The risk is spread across all member nations, making it a secure way to participate in global finance. It's also important to note that the Philippines doesn't decide who gets the money. The IMF's board, made up of representatives from all member countries, votes on which nations receive support and under what conditions. The Philippine contribution was available to any IMF member in need, not just countries in Europe. In fact, if the Philippines ever faced a crisis, it could also draw from this same pool of resources. This move was about participating in a multilateral system, working together with other nations to keep the global economy stable. It wasn't about bailing out Europe or any single country, but about strengthening the safety net that benefits everyone. By making this commitment, the Philippines reinforced its reputation as a responsible global citizen, showing that it's willing to help build a more resilient and cooperative international community. $250 million may seem small compared to the IMF's $430 billion fund, but for the Philippines, it was significant. The amount could have funded major domestic programs, classrooms, healthcare, poverty relief, yet it represented just 0.3% of the country's $83 billion in reserves. The symbolic value was huge. A former IMF borrower was now a creditor. This reversal marked a turning point in the country's economic story. The move signaled to the world that the Philippines was no longer the sick man of Asia. Other emerging economies also contributed, but the Philippines' pledge stood out given its smaller economy. It was a statement of solidarity and a sign of growing confidence. The act showed that even smaller economies could play a role in global stability. It was about more than money. It was about reputation and responsibility. The world took notice, and so did Filipinos at home. The decision wasn't charity, it was economic self-defense. The Philippines is deeply tied to Europe through trade, investment, and millions of overseas workers. A European collapse would have meant lost jobs, lower remittances, and economic pain at home. Remittances are a lifeline for millions of Filipino families and a key source of foreign exchange. The central bank saw the IMF contribution as insurance, a small premium to avoid a much bigger crisis. By strengthening the IMF, the Philippines was also protecting its own future access to emergency funds. The move was proactive, not reactive, a sign of maturity in economic policy. In a globalized world, protecting others can mean protecting yourself. Beyond economics, the IMF pledge was a diplomatic win. The Philippines gained credibility and a stronger voice within the IMF. This influence matters. IMF decisions affect all members, including the Philippines. The gesture built goodwill with Europe and other global partners. It was a strategic investment in political capital, not just financial stability. The move aligned with the Aquino administration's push for good governance and international engagement. The pledge became a form of international branding. The Philippines was open for business and ready for a bigger role. It was a smart play in the arena of global soft power. The announcement sparked fierce debate at home. Many Filipinos felt pride. Finally, the country was a global creditor, not just a borrower. But critics argued the money should have gone to urgent domestic needs. Charity begins at home became a rallying cry for protesters. Social media buzzed with images contrasting European wealth and Filipino poverty. The debate exposed a real tension: global engagement versus immediate local priorities. For the government, the pledge was about long-term protection. For critics, the benefits seemed too distant. The world applauded, but at home, the conversation was far more intense. Myths quickly spread that the Philippines gave away money to Europe, or that the funds were lost forever. In reality, the commitment was a line of credit to the IMF, not a handout. The money stayed in the country's reserves unless actually needed, and it earned interest. Lending to the IMF is one of the safest investments a country can make. The funds came from international reserves, not the national budget for social services. Comparing the IMF pledge to domestic spending is misleading. They're separate pools of money. The decision was technical and strategic, not reckless or naive. Understanding these facts is key to an informed debate. The real story is about prudent reserve management and global responsibility. The 2012 IMF commitment marked a new era for the Philippines. It was a milestone, from debtor to creditor, from aid recipient to global stakeholder. The move sparked national debate and raised economic literacy. It showed that no country is an island. Global crises can quickly become local problems. The decision was a calculated act of enlightened self-interest. As emerging economies grow, they must balance global responsibilities with domestic needs. The Philippines story is a lesson in the challenges and opportunities of an interconnected world.